All right, good afternoon. I'm Doug Mitchell with Ogletree Financial, and also on the presentation today we've got Louis LaBache. Just want to give you a quick intro to Ogletree Financial. First of all, thanks a lot for taking the time out to be on our webinar today. If you're new to these webinars, we have a marketing webinar every Thursday afternoon at 1:30 Central Time. So keep watch on your emails and make sure you attend those. But for our licensed producers, we've got a Tuesday training session, and every Tuesday at 11 Central, we go over a sales concept or a new piece of software calculator that we've got, or a presentation that we've got to help you get in front of more folks, sell more business, and make more commission. That's what it's all about. Getting back to Ogletree, we're an IMO or an MGA or whatever the carrier calls us, but what our job to do is to help the independent insurance agent out there make sure that they've got the best product to sell, the best tools to sell it with, and the prospects to go out and see. And so Louis has developed some great calculators. You're going to see one today, but some great calculators that help your clients to understand what this stuff's all about, what indexed universal life is all about, what wealth transfer is all about. So we've got some really good stuff. We got a great website you'll probably want to check out. It's called IULWorks.com. That's IULWORKS.com. It's where we put the recordings of these webinars on. We have a lot of our tools and some sales ideas and concepts on that website as well. I wanted to mention two real quick things before I give it over to Louis for the presentation. But just to let you know, we do have a producer conference that we just released the information on last week. We're going to the Riviera District in Cancun, Mexico in 2014. It only takes $50,000 in target premium, so it's a very easy trip to hit. It's going to be for you and a guest. It's all expenses paid, airfare, food, drinks, resort, everything. It's an all-inclusive place called the Now Resort. And so I know it's a nice place because we're taking the guys from the 2013 trip to the Punta Cana Now Resort. And so great place to go. You want to put your business with us because we pool all of your production. Doesn't matter what carrier it comes with. It could come from North American, Lincoln, Transamerica, whoever we represent. We're going to add it all together, and that's going to qualify you for the trip. Just one more quick note. If you're into trips, we're going to Vegas here in a few more weeks with North American. So not only can you qualify for the Ogletree trip, but we've also got carrier trips that you can also qualify for, and the production piggybacks on each other. So just another good reason to do business with us here at Ogletree, and that's in addition to everything else that you get. So Louis, I'm going to hand it right over to you and let you show them this new tool that we got.
Okay, Doug. Hey, thanks. Hey, good afternoon, everybody. This is Louis LaBache, and today we're going to talk about how to rob a bank. Actually, that's how I coined this whole deal, and we're going to get in to show you how to do that. So first of all, let's just talk about the agenda. So we're going to talk about concerns, people's concerns, what they're concerned about, and how we can help them feel a lot better about everything. All right, and we're going to talk about what people want and when it's about money, and a few little bullet points about that. We're going to show you the target market, the people who you should be talking to about this, basically. And we're going to talk about what we can give them, because we can really help them in this trying times. We can really help them a great deal, and we're going to show you how that works. So, and we're going to show you easily how you can easily explain it to everybody. That's probably the most important part of this, is that some of this taxes and tax deferral and how much you get to spend and all the other things like that can be kind of complicated, and we're trying to make it as simple as possible for you to explain to people some of the situations that they're looking at and a different perspective and how we can help them. So one of the things that brought to mind is that this is an article from Schaefer's research from a couple months ago, and this is excerpts from that article. And basically, the concept here is that there are an awful lot of people and also awful lot of corporations that just have a whole bunch of money sitting on the sidelines. They're basically, the articles have stated that people have lost billions of dollars because they stuck it in these CDs paying less than 0.5% or 1% or some number like that because they're afraid to put it in the market. And the money's still sitting there. And even though the market has been taken off, I mean, this last year has been a really good year, and people are still sitting there because I guess they have short memories and they can all remember 2008 pretty well. So the idea behind this is that we have all this money sitting aside, and people don't know what to do with it, and they're concerned about what to do with it. And we can help them very easily, safely take this money and really take advantage of some really great returns. So when you talk to somebody, and basically this is what they're all thinking about, they may need access to the money. That's what they're worried about. They want to leave as much to their family members as possible. And a lot of people feel that their money's better chance to grow if it's linked to a stock market index, and we feel that way, rather than in a stock market index. Okay. And they're also worried about this other thing called long-term care. And as people are getting older and we're living longer, there's just the percentage of chances of people needing long-term care are going up every day. And so we've got some solutions that address all of this that we have right here in front of us, which people are thinking about. Right? So most of them don't want to roll the dice because, when you roll the dice, what we have is a number of things to look at: money, time, value, all the things that come out when you take the money and put it someplace in the market. And all these things could be good for you or they could be bad for you. And if you don't have a lot of time, you can't take a lot of risks, no matter how much money you have. And the idea behind this is that we can help them alleviate some of these issues, right? Also, what they want is they want liquidity. They'd like to get the highest return on investment, and also at the same time they want the lowest risks. So some of these things don't always go together. Most products don't provide you with all these things, but we've got a product here that we think that's unique in the marketplace that can provide them with liquidity, a good ROI, and very low risk. Right? And also the other thing is what they want is they want safety, and we can provide them with the safety. Also, part of this product allows them to have a tax-free transfer of money to their family, and the money, as it's growing, earns tax deferral. So basically, they don't have to pay any taxes as they go, only if they ever need it or use it. And if they never take it out of the product and they end up passing away, all of the money in the product goes income tax-free onto their heirs. So they have some great opportunities here versus leaving money in 401k plans that are ultimately going to be taxed one way or the other. They're even taxed when you die. And if you're one of the savers of America who has saved a lot of money in their 401k plan, those people generally are the same people that also put their kids through college and got them PhDs and doctorates and Juris Doctorates, and their kids are all doing quite well for themselves right now. And as a matter of fact, if these people happen to pass away and leave their 401k plan to their successful children, at the end of the day, the children who are in a very high tax bracket and the parents who are not in such a high tax bracket, when they take the money and hand it off to the children, immediately all that money gets a nice 10% increase in taxation because you pay based on whoever spends the money is what the rate is. And if they're making if your kids are making a good living and you leave them the money, they're going to pay a higher tax than you would. So these are some of the problems that people have. So also what they want is, in all cases, they'd like to have something that's no load, no load, no load. And we're going to provide them with something like that. Right? So the target market for this is, as I said, this is how to rob a bank. The people we're going after would be people who have CDs, money market funds, right? Those are the two things. Also, people that have whole life insurance, are great, because they got these whole life products that basically are not producing very well and are, kind of like, coming to the end of their times, and they don't want to pay the premiums anymore. So those are great, prospects to take whole life money out of that and put it into something like this, do a 1035 exchange even. UL policy owners, people that have bought ULs in the past that, generally speaking, have not lived up to expectations. And there's quite a few of those out there as well. And so this is another way to help move that money that's in there, if there's anything left, to get them a better place to put it. And then, of course, annuity prospects. So if you're selling annuities today, they are making a little bit of a comeback, these annuities, and probably, if you're selling annuities, you're probably selling the lifetime income riders more than anything else. But the annuity prospects, they're not real happy with the caps in these products today. 3-4% is not a great number to be shooting for to build a real income or a cash account, so that someday you can go buy a boat or something like that. So they're at an all-time low from CDs, an all-time low from annuities, and of course these are the prospects that people who have their money in these types of accounts are the ideal candidates for us to talk about what we're going to talk about. Now, how do we explain it? Well, one thing that we actually went, and the product that we're talking about is the Rapid Builder from North American, and it's an Index Universal Life product, and it's got some unique features in it, and one of them, it's called the Waiver Surrender Charge Rider. So basically, what it does is when we put this rider on it, it actually takes away all the surrender charges. So if somebody puts, as an example, $100,000 in the policy and they want to surrender the policy in a year or 2 years, they're going to get their $100,000 back plus some interest as well. So it's got the ability that people, when they put their money in, they get their money back out if they need it. Right? It also includes life insurance. So when people buy this product, they have to buy a minimum amount of life insurance. Generally, it's about a 2-to-1 ratio. And in the case of this example, this person puts $100,000 in, and they have $105,000 of cash value into the year and a death benefit of $258. So the 105 is if you look at this, is more money than they get out of their out of any CD today for $100,000 in a time frame. And also the 254, not only is that a death benefit, but also in most states, except for California and Connecticut, that 254, 24% of that could be available on an annual basis to pay for long-term care in cash. So they get a savings account that's earning much better than their CDs, plus they have life insurance and long-term care insurance built into the product. Now, we got this approved from North American, and basically it's a fillable form, so you could actually put in your name and your phone number, your contact information in here, print it out, and hand it out to the world, and you would be the person to talk to about this whole concept. So it's got all the information you need to actually start a discussion about this, and then we're going to show you some ways you can really explain this. So going forward, I built this calculator, and the calculator really addresses the issues that people are concerned about. And what you do is that you click to start, and these are some of the things that are going on that are really important, especially in this low interest environment where people are earning less than 1% or 1% on their money. There's one thing that's coming to get them at all times. It's that little thing called inflation. And just to show you an example on this graph, in 1990, $100 bought $100 worth of stuff, okay? That same $100 in 2010 would buy you $348 worth of stuff. So that's what inflation can do to your money. So, and if inflation is about 3%, and if the best CD you have out there is earning 1.5%, you're losing 1.5% a year. So basically the idea behind this is that we have people, if they have their money parked in a CD, they're actually losing money. Even though they're getting 1% or 0.5% or whatever the number is, they're losing money. And over time, this could be pretty devastating to them. As an example, let's suppose somebody had $10,000, and if the inflation was 3%, and this is the calculator, I'm just going to type in 3%, and it just shows over 10 years, 3% compounded ends up being a 26% deficit. So here, this $10,000 in 10 years is only $7,000 worth of purchasing power. And if you take it out over 30 years, it drops down to $4,000 in purchasing. They lose 59% of the purchasing power just from a 3% inflation. So that being said, even though they're earning money on their money in some CD, and we'll just take a look at that. Let's suppose that they've had $100,000 and they were getting 1%. I'm going to give them 1%. All right. and their income, because it's all taxable in these CDs and money market funds. Let's just suppose they're in a 25% tax bracket, and inflation is about 3%, right? Well, what this says that over 10 years, even though they're earning money and have to pay taxes on it, they're still going to lose 20% of their spending value in 10 years. So to leave the money in here is not a good plan, because if they have it parked and they park it too long, it just keeps getting worth less and less every year. And it could be, if they were in a 40% tax bracket, doesn't make a lot of difference, but it still comes into play. All right, and so the idea is that if they're getting a 0.5%, whoops, that's if they're getting 5%. I got to do this right, and I'll get it pretty good here. The rate of return is 0.005, and they'll see that inflation is like 24% even. So the idea is that it's not a good thing for them to leave their money parked in these CDs, because they're just losing money. So what we have is this thing called, I call it CD insurance, okay? And what we're going to do is that we're going to buy a single premium life policy called Rapid Builder. And if you could hear all that noise out there right now, I don't know if you could hear it very well, but I'm in a condo in Florida, and we're actually getting our condo washed today. And of course, right at the time we're talking about this, he has to go wash the wall outside my office. But in any event, if you had $100,000 in this policy, and this client, if he was 50 years old, he put in $100,000. The end of the year, first year cash value, the guaranteed cash value in the policy is $100,788. Well, that's what he can walk away with if he wanted his money. And the projected death benefit at the end of the year is $298. All right, and the projected, this is the guaranteed, and this is the projected cash value, is $105. Well, in the CD, he's getting a whopping 0.5% or maybe 1%, which would be $1,000. So he may, on a guaranteed basis, he may be giving up a couple $100, but on a projected, potential basis, because he can earn up to 13.5% in this product, it's $105,000 is what he could have. And if you take a look at this, this just shows that the guaranteed cash value is this. The projected cash value is $105,000. This is the death benefit that's built into the product, in this case for a 50-year-old. And this death benefit, because of the way it's designed, they can get up to 24% of it in cash on an annual basis for long-term care. This has a $286,000 potential long-term care benefit built into this thing. Now, if we take this 50-year-old and move him up to 51, or 52, or 53, or 54, or 55, now you can see that there's quite a big difference here. $131,000. He has $103,000 guaranteed built into the policy, but he can projectedly get $131. And if we just go look at the benefit summary, okay, this basically says what happens is if he took the money and he was getting 1.5%, and I'm actually going to take this and make it 1%, because that's more likely what it is, all right? If he was getting 1% on his money, if he puts it into the policy, he's going to get 99.56% of that on a guaranteed basis. It's going to cost him about 0.44% basis points, or 44 basis points, basically, to have this insurance for 5 years. And that's the guarantee. That's the worst case that could happen to him. That's if the market went downhill every year for the next 5 years, all right? But the death benefit has grown, projected at 326, and the cash value could be as much as 131 based on the 8% projection that we have in the policy. It actually could be more than that, but this is a conservative projection. It's about, the insurance company only lets project about, 60 or 70% of what the cap is in this case. And so the idea being is that on a guaranteed basis, he gets almost 100% of what he wants, okay? On a percentage of CD, basically the CD versus the insurance, if something happened, he'd get 300% of what he put in there, because if he died, basically. And basically the profit, 103,000 in the CD versus potential 131 in the policy, and that's we're talking about 800% increase for this person. Now I'm going to move this up, and this works. This is a 50-year-old, all right? So we move it up, and I'm going to make him a 55-year-old, and you'll see that the 55-year-old, and we'll take it out 5 years for that person as well. and you'll see that the numbers are, there's a little more insurance costs, so his guarantees are a little bit off, but he still gets 270% if he dies. He gets 800% if the projection meets the numbers, and this is the long-term care number. He gets 259% of that versus the 100,000. So 2.5 times more money to pay for long-term care. And it actually works. If we take it up to a 60-year-old, it moves right along, and you'll see that a 60-year-old, it ends up at age 65. It costs them a little more on a guaranteed basis because of the life insurance costs, okay? But that's guaranteed. This is if the market went straight downhill. But on a projected cost, he still gets 8 times as much money as he get out of his CD, earning 1%. And it actually keeps on working. We're going to go up here to a 65-year-old, and I'll just take it up to 69 years, or 69 to 70, all right? So this one, the 70 or 65-year-old, now he's going to, on a guaranteed basis, if he really wanted his cash out, he'd have to pay a little bit. It's going to cost him, for having that amount of insurance to start with, okay, basically $211,000 of life insurance to start with. It's going to cost him basically about $2,000 a year. Worst case, and that's if the market was to go downhill every year for the next 5 years. On the other side of the coin, it could actually earn him 7.5 times as much money as he'd get in his CD. And if he needs his money, he could take it out. So the idea behind this is that we have people that are putting money, that have money in CDs that don't want to put it in any place because the returns are terrible, and why take it out of a 1% CD and stick it into a 3% annuity and tie it up for 10 years, for whatever, with the sales charges and everything else that are there. And if I need my money, I got to pay penalties, et cetera, to get that 3%. With this, we're going to give them the opportunity that they get majority of their money back. Even so, if we look at this guy, if we look in the 60, let's just go back down here, and we look at 66. All right, he's guaranteed 98% of his money. All right, guaranteed. And the projected cash value could be 105, which is 700 times, 7%, 700 times more, or 7 times more than he would get out of here. So the idea behind this is that there is a real cash opportunity for somebody to put their money in one of these policies, get insurance at the same time, get long-term care coverage at the same time, and also earn a great deal more money and actually have access to their money if they need it. So that's the way the product works. It's pretty simple. So basically what they get is they get a minimal index universal life with a single premium option. It's equal to about 2 times the single premium. That's the death benefit they get. They get life insurance that provides income tax-free wealth transfer. This product has a 13.5% cap, so basically they can make as much as 13.5%. It has a 0 downside risk, and it includes annual reset. So the idea behind this is that people can put the money in this thing, and if it goes up, it stays up. If it goes down, nothing happens for the most part. It has guaranteed returns, so they get a 3% guarantee. They get a return of premium option with for the basically life and death. I got a little glitch in here with liquidity. They can take withdrawals at or 0 net cost wash loans out of the policy years 1 through 5. They can say, I just want some money. They can do withdrawals. It's a universal life policy, or they can borrow the money at 0 cost in the first 5 years. They can actually borrow it out after in the 6th year on using the arbitrage. So if the policy, like example, everybody who had one of these products last year who borrowed the money out of the policy, they paid 4% interest if they had a variable loan to borrow the money out. But that money actually earned 14% in the market last year. The cap was 14 on the products, and they earned 14%. So they paid 4, took the money, went and bought a boat with it, did whatever they want with it, went on vacation, and the money still was in the policy and earning 10% on top of that. So there's no other product in the world where you can actually take the money out and still earn money. Now, the issue with this is that he has to take the money out. One thing is that it is a MEC, and it's subject to a 10% penalty if he's under 59.5. And generally, the best prospect for this would be somebody 60 or older, and the numbers do work for them. Or if somebody who's going to wait till 60 to take the money out so they can get away from that 10% penalty. But the idea behind this is that they can't put the money in, and they can't take it out if they need it. Normally, if they're going to put a big chunk of money in here, they don't necessarily need all the money unless there was an emergency. But if they had an annuity and they put $100,000 in it and they had an emergency and they needed $50,000 for some reason, they'd have to pay a big penalty to get the whole $50,000 out. They can take out 10%, but they can't take out 50%. What if they could take out 50 and there's no charge, basically, to do it, right? So there's no withdrawal sales charges the way this product is built. And then there's a tax deferral on the gains. So basically the money's in there growing. There's no taxes until they take it out. So it beats a CD. There's no taxes that way. The returns are much higher than any CD going today and any annuity because of the caps, right? This is an A-rated company. It's North American. That's what the numbers came from. They have a 93% Comdex rating. They're an excellent company. They pay excellent commissions, and that's the other thing that's going to come up. What is the commissions on this thing? Well, it's life insurance, and the way it works is that if you bought $200,000 on a male age 60, the commission on that is somewhere in the neighborhood of about $3,000 or $4,000. That's what you'd make. It's $200,000 because you get paid for the life insurance, so you make $3,000 or $4,000, and then that's the target premium on the policy. But then after and above the target premium, there's an overage account, and with the rapid builder, you get 3% of the overage. So on a $100,000 premium for a, say a 60-year-old, you'd get about $3,500 in commissions for the $200,000 life insurance. Plus, you get 3% of the $97,000 overage, which would be another $3,000 as an example. So you get about $6,000 on $100,000. So it's about 6%. And it varies between age to age and et cetera, but essentially that's how it works, and it's very competitive with what you're getting from any annuity product, but I think you're going to find this is a much easier sell. There's no withdrawal charges. There's no money locked up for 10 years or 14 years to get the cap. And the cap is, 13.5% is 4 times bigger than just about anything out there on the marketplace. And the whole idea behind this is they also get life insurance and long-term care insurance, and it's also a cash long-term care insurance policy. So there's no reimbursement. If they qualify, they can get the 24% of the face amount in cash to go do what they want with it. So that's what the product works. And essentially, the idea behind this is to go out and sell this to people. The only major difference is that with annuities, there is no underwriting. Generally speaking, if they can sign the paperwork, they can qualify. With this, people in older ages may have some health issues, but with this waiver surrender charge rider built into this product, what that means is that table 3 equals standard. So this is like if somebody's a type 2 diabetic and otherwise in good shape, they would be qualify for this product with the standard rates. And those numbers I showed were standard rates. If they're healthier, it would even be better. But if it's at standard rates, those are the numbers I ran. So that being said, I want to let Doug finish this thing up and talk about all these things.
Yeah, Louis, great presentation. This is a product we've had for a long time, and although we've used it quite a bit, I think now is a great time to be breaking it back out and really introducing you guys to it. Most of the people that we work with are life insurance producers, so I think we got a lot of annuity guys on the call today, and this just shows you there is an answer to those annuities out there today that are paying lower commissions, they've got lower caps, and longer surrender charge periods. So it's a great product. Louis mentioned the commission. We do offer the top street contracts with North American, so I'll tell you that's 95% on the target. It's 3% on the excess on this particular product. So if you do the math, it's very comparable to annuity comp, if not higher. Sales material, we got so much of that stuff that it's unreal. You've seen some of it today. You're going to get the presentation that we just went over, the CD presentation and the robbing the bank calculator. All you have to do is get in front of your clients with your laptop, punch in a few numbers, and explain to them, this is your CD, this is what we got. You make the choice. So marketing videos, you'll see at IUL Works some of the videos that are available there. I mentioned earlier weekly training webinars every Tuesday. You get in-depth training, and what we typically do is we take a topic like we went over today, but we're going to show you exactly how we take the illustration, the numbers out of the illustration, we put them into the software. We show you how to talk to your clients about this stuff, and teach you how to prospect on these things. So illustration support, just call us. We can run it for you. Marketing list, mailing list, they're everywhere. Everybody's got marketing lists out there. We do too, but we've got some ways that you can approach these people with our videos and our mailers and scripts that the mail houses just don't give you. Awards, trips, and contests. We went over that a little bit, but I didn't mention the contest. Throughout the year, we always have contests running, and it's usually something that we pick that's hot out there. For instance, iPad giveaways. We've given away tons of iPads out there, and just for simple stuff like writing 5 applications or things like that. But guys, we really want your business. I mean, we offer all of the carriers that are in the industry that are worth anything. I mean, we don't represent 100 different carriers, but we've got 15 core carriers that you can take with you and go to any client, and we've got something for. So keep in mind, this stuff doesn't cost you anything. We were talking earlier to an agent, and he was telling us that it cost him $200 a month to just be part of an IMO so that he could get their marketing tools. And they really weren't tools. They were illustration software. It was the Aviva illustration software that the guy would have to call in, talk to a marketer there, and they'd run him an Aviva illustration. And that support cost him $200 a month. We're not into that. We make an override when you sell business. So what our goal is to help you sell insurance. And through these tools and these trainings that you're not getting out there on the street, we feel that we can help you do that. So give us a call. Our number's on the screen. It's 800-466-8186. Talk to Louie, talk to me, doesn't matter. Hit extension 1 or 2. We're going to get an email out. Everybody that registered for the webinar is going to get a copy of that CD calculator. So be looking for your email. We're going to get that out to you. And we'll also include some information on the product, contracting, and commissions. And guys, we look forward to working with you. Give us a call if you have any questions. Louie, thanks a lot for that presentation, and thank you guys for taking out the time today.
Hey, thank you all for coming. Call right when you find work. That's all I could tell you.